Welcome to vTalkInsight Allocator's Lens Daily for February 13th, 2026. Stronger U.S. payrolls, sticky inflation, and a surprisingly soft dollar are forcing a rethink of the rate path. Even as dispersion explodes across equities and commodities, signal tighter fundamentals. Let us start with equities, where the push and pull between robust growth and mounting micro risks is now the central question for portfolio construction. In equities, the big tension is between strong macro data and increasingly fragile microdynamics. On the supportive side, a powerful U.S. jobs report, with payrolls running at the fastest pace in over a year and well above forecasts, reinforces the soft landing narrative and helps explain why risk appetite has held up despite fading hopes for early Fed cuts. Yet we have also just seen a broad risk-off day, with major U.S. indices selling off sharply and volatility picking up again, reminding allocators that high valuations leave little room for disappointment. Leadership within equities is rotating hard. Value, small caps, and non-U.S. markets such as Europe, Japan, and parts of Asia have been outperforming traditional U.S. growth leaders, helped by accelerating activity abroad and a weaker dollar. In the U.S., gains have recently broadened beyond a few mega-cap tech names, with cyclicals like consumer discretionary, financials, mining, and energy outperforming at times. However, several strategists now argue that this low-quality and small-cap phase may be short-lived, with a likely swing back toward high-quality large caps as consumer fundamentals soften and earnings growth expectations cool. Europe is a clear example of how unforgiving this equity environment has become. Dispersion there is at record highs since the global financial crisis. Reporting season is broadly stable, yet stocks that miss estimates are punished severely, and even beats often trade down, a classic sign of markets priced for perfection. AI adds another layer of dispersion. Semiconductor companies still enjoy strong earnings visibility and margins, while software has seen indiscriminate selling that some view as creating bargains. At the same time, fears of AI disruption are hitting service sectors and pushing flows into perceived AI-resilient areas like consumer staples, metals, mining, and agriculture. Outside the U.S., earnings momentum is healthier in several regions. Asia and emerging markets have delivered stronger earnings performance this year, and investors are rediscovering markets such as Europe and the U.K., where indices like the FTSE 100 combine low-tech weight with more modest valuations. Individual company reports underline the importance of pricing power and brand strength, from luxury and staples names delivering resilient growth to fast-growing digital and infrastructure businesses guiding well ahead of expectations. Going forward, allocators are likely to focus on how far the rotation away from U.S. mega-cap tech can run without a macro slowdown, how harsh the market remains on any earnings miss, and whether defensive sector outperformance alongside a cyclical upswing is an early sign of deeper recession worries rather than just AI anxiety. Turning to rates, the latest U.S. labor data have materially shifted the policy discussion. Non-farm payrolls came in more than double expectations, and broader measures show job gains spreading beyond healthcare and education into goods-producing industries, with diffusion at a two-year high. As a result, markets have repriced the first Federal Reserve rate cut from June toward July. The odds of a March move have largely disappeared, and some forecasters now even talk about no cuts for several years. The complication is inflation that looks stubborn rather than rapidly fading. Despite earlier disinflation, some analysts expect core consumer price inflation to print around 3.9%, and there's a growing narrative that U.S. inflation is not just sticky, but potentially stuck. At the same time, financial conditions are the most accommodative since 2022, which supports growth but reduces the urgency for the Fed to ease quickly. In this setting, 2-year and 10-year Treasury yields remain elevated, with the 10-year stuck in a range between roughly 3.75% and 4.25%. Fiscal dynamics are adding another layer. The U.S. Budget Office has lifted its deficit projections by over $1 trillion, and investors worry that sustained high long-term yields could eventually create a negative feedback loop for public finances. Long-end auctions are seeing heavier dealer participation and post-auction cheapening, which some read as a sign of more cautious real money demand for duration. In contrast, The UK faces slowing growth and is expected to see additional Bank of England cuts toward a more neutral rate, highlighting policy divergence that will shape global curves. For allocators, the key watch points now are incoming inflation data, treasury supply, and how far yields can stay elevated before they begin to bite more meaningfully into risk assets. Credit markets still look firmly risk-on, especially in higher quality segments. Recession risk is seen as relatively low, and investors continue to favor investment grade and select high yield to pick up income while maintaining what they view as resilient fundamentals. That confidence is visible in record-breaking issuance from large technology firms, where recent multi-billion-dollar deals have been met with exceptionally strong demand. Much of this supply is funding enormous capital spending on AI infrastructure. Guidance from the largest platforms points to a step up in annual capex on the order of hundreds of billions, leaving some household names temporarily in negative free cash flow territory. Bond markets so far appear relaxed, treating these deficits as short-term and expecting future cash generation to more than compensate. Even so, there's growing concern that heavy borrowing by a handful of big tech issuers is creating concentration risk in benchmark indices, and that some pockets of credit are beginning to show spread widening as investors differentiate more aggressively. Headline spreads in U.S. and international markets remain near multi-decade lows, masking substantial dispersion beneath the surface. That tightness offers carry, but leaves a limited cushion if growth disappoints or if inflation forces a more hawkish rate path. Episodes where treasuries rally while gold and crypto sell off during equity drawdowns also suggest that, for now, traditional sovereign paper retains more safe haven status than many alternatives. From an allocator perspective, monitoring sector-level spread behavior around further heavy issuance, especially in tech and consumer-exposed credit, will be crucial to assessing whether this benign phase can persist. In foreign exchange, the standout theme is skepticism about U.S. exceptionalism, despite strong data. The dollar has weakened significantly, and several large asset managers have been cutting U.S. exposure, citing policy unpredictability and an expectation of a multi-year dollar downtrend. The currency is widely viewed as structurally overowned, with many participants looking to sell rallies rather than buy dips, and positioning is heavily skewed towards short dollar trades. What is striking is that even a blockbuster U.S. payrolls report has not delivered sustained dollar strength. The greenback is failing to appreciate meaningfully against the euro, which suggests that markets may be questioning how long U.S. growth can outpace the rest of the world, or are instead focused on the eventual policy pivot rather than the near-term strength. This dollar softness is reinforcing the rotation into non-U.S. assets, particularly in Asia and parts of Europe, where earnings profiles are improving from a lower valuation base. The Japanese yen is another focal point. One camp expects further yen strength against the dollar, pointing to narrowing rate differentials, ongoing domestic inflation, and the risk of official intervention to cap sharp currency moves. Another view stresses Japan's weaker structural fundamentals, including slow growth and high debt, and argues that recent yen gains are more likely tactical and could eventually reopen carry opportunities. How this debate resolves, together with upcoming Federal Reserve and Bank of England decisions, will have an important bearing on cross-border equity and bond returns as allocators reassess how much currency risk they are willing to run. Commodities are sending a clear message that underlying fundamentals are tighter than many headline narratives suggest, especially in energy. Refinery throughput in January exceeded expectations by around 2 million barrels per day, with U.S. runs up roughly 1 million year-on-year despite challenging weather. Official data show that global oil inventories have not built as much as predicted, while logistical constraints on Russian exports could remove hundreds of thousands of barrels per day from the seaborne market, even if production remains steady. Geopolitics are amplifying these pressures. Oil prices have been rising again as tensions between the U.S. and Iran raise concerns about potential supply disruptions. At the same time, China is actively stockpiling both oil and industrial metals, potentially adding up to 1 million barrels per day to reserves, which tightens global balances further. Looking ahead, U.S. policy shifts are enabling Chevron and others to expand production in Venezuela, with expectations of a 30 to 40% output increase within a year and further gains over the next 18 to 24 months, which could eventually offset some of today's constraints. In precious and industrial metals, the signals are mixed but important. Investor FOMO has rotated at times from equities into gold and silver, supported by persistent geopolitical and policy uncertainty. Gold demand is increasingly driven not just by central banks diversifying reserves, but also by newer buyers, such as stablecoin issuers, with expectations that annual demand could exceed previous highs. However, there are also episodes where gold and Bitcoin sell off alongside equities while treasuries rally, reminding allocators that no single hedge is reliable in every sell-off. Taken together with the outperformance of metals, mining, and agriculture equities, commodities are reasserting their role both as an inflation and policy hedge and as a direct beneficiary of the ongoing AI and infrastructure investment cycle. Pulling the pieces together, the cross-asset picture today is one of robust growth, delayed, but still anticipated monetary easing, and a gradual erosion of dollar dominance, all playing out against increasingly tight valuations and sharper dispersion. Equities remain supported by the macro backdrop, but are far more selective, with harsh reactions to earnings misses and leadership rotating across regions and sectors. Rates markets are wrestling with strong labor data and sticky inflation on one side and rising fiscal questions on the other, keeping yields elevated. Credit stays firmly risk-on, with tight spreads and heavy tech issuance, while FX and commodities both express a shift toward non-U.S. exposure through a weaker dollar and tighter energy and metals balances. For allocators, the key watch points now are the next inflation prints, central bank communication around the timing of cuts, any broadening in credit spread weakness, and whether the dollar downtrend continues to channel flows into international assets and real assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.